Well, a very warm welcome to the ACT Annual Conference and to this UniCredit session. I'm David Vials, I'm Head of Corporate Coverage for UK and Ireland, and I'm joined today by Dan Bucsa, and Dan is our Chief CEE Economist. Welcome, Dan.
Hello, David.
So, for those of you who are not familiar with UniCredit, we are a pan-European bank with a unique footprint, and it extends across 13 countries in Western, Central and Eastern Europe. We are the largest corporate bank in the CEE. Today, we would like to talk to you about the CEE region and in particular focus on the state of the CEE economies, key trends that we see and the recovery prospects for the region through 2021 and indeed beyond. So Dan, if I may, let's start with the first question. How does UniCredit see the recovery developing in the CEE region over the coming months?
So in order to talk about the recovery, I think we need to say a bit about where we are at the moment. Central and Eastern Europe is coming out of a third wave of the pandemic, and the situation is improving as these economies reopen. We've seen the worst of the pandemic in March and April this year, but with May and already June data, we're seeing a clear improvement in the economic situation. Obviously, this rebound is not, let's say, as strong in every sector. Industry is leading the way at the moment. Services are lagging, but we do think that services will catch up over the summer because there's a lot of pent-up demand in these economies. And talking about industry, what we're seeing is emerging supply chain bottlenecks in a few sectors, and we think these will stay with us for the rest of the year. It's very well known, the car manufacturing is affected by shortages of microprocessors, but we've also noticed other shortages affecting industry in chemicals, especially paints, but also plastics, in rubber production, textiles, and also metals. So despite very strong demand coming from abroad and also domestic demand, we do face these issues in production. However, I would say the situation over the next few months is likely to be very good across the region. There are some differentiations when we're looking at these economies because some of them are stronger than others. And you can see on the attached slide that there are countries where domestic demand is recovering quicker than in other countries. And here I would highlight Poland, I would also highlight Romania, and we're also seeing Turkey recovering quicker. At the other end, Czechia, who's always trailing because the consumer is far more cautious to restart spending. It's not a matter of having the money, it's more a matter of the outlook.
Okay. Now, so moving on from the recovery, has Brexit, I guess, to a large extent as well, the pandemic and the associated supply chain challenges, has it had a positive effect for CEE in terms of the region being a destination for foreign direct investment? And here I'm thinking a bit in terms of, do we see the prospect for increased reshoring or nearshoring in CEE? And maybe a bit, if you can, some color around which industries you feel are best suited or more likely to consider an expansion or a move into CEE, given those potential effects.
I think we should treat separately reshoring and Brexit, and I'll start with reshoring. What we've noticed is that the EU does want to bring back some production to Europe, especially pharma and chemicals, and this is likely to benefit also CEE because there are countries that are already producing pharmaceuticals and chemicals. And I would highlight here Croatia, for example, or Slovenia. Although very small countries, they do have a tradition in this. We're also seeing some car manufacturers thinking of shortening the supply chains, but I don't think it's going to be a massive repatriation of production to Europe. And we've seen several car producers saying that the main problem they're facing is available labor force. And The only country that can compete from Central and Eastern Europe in terms of available labor force with Asian countries is Turkey, which has around 85 million people. The other countries, though, do have a good tradition in manufacturing, and I do think that some of them will benefit from more investment. We're seeing it already, for example, in electric batteries, where Bloomberg ranks Hungary and Poland equal 6th globally in terms of production. So these relatively small countries are definitely doing better than the size of their economies would suggest. So if I were to wrap up, chemicals, pharma, and to some extent also manufacturing, so car production, for example. Talking about Brexit, I would say that Brexit has been happening for this region now for a while. We've seen exports to the UK declining gradually after the Brexit vote. We've also seen a change in the structure of products exported to Britain. For example, car manufacturers have exported cheaper cars to Britain than before the Brexit vote. And this has continued. In 2020, particularly, exports were down significantly for all countries across types of goods. So besides importing cheaper goods, we've also seen Britain this year struggling to export to the EU. And from the first data we have for the first 3 months of the year, I would say it's clear that there's an asymmetry in trade barriers imposed by the EU and the UK. It's more difficult for UK companies to export to the EU than it is for UK companies to import from the EU. The good news is that the data out for March, which is just for a few countries, shows trade with the UK rebounding strongly. So hopefully we'll see this happening in the next months also for the other countries.
Okay. So given that, what should companies be thinking about as they potentially explore investment options across the CEE region?
So we're talking about a region that is likely to grow at more than 5% this year if we're excluding Russia, and probably about 4% next year. So very strong growth, given the fact that many investors think of these countries as the developed markets of emerging markets. This kind of growth rates above their potential is very strong, and it's also sustainable in the midterm. I want to highlight two things here. First of all, the fact that the private sector in these countries exits the COVID crisis in a better financial position than it entered this COVID crisis. And I will start by talking about households. So if we were to compare what households are doing now with the aftermath of the global financial crisis, you can see on the slide on the right-hand side, the situation is markedly better than it was in 2008, 2009, 2010. And this is because these economies have adjusted after 2009. So macroeconomic imbalances were much smaller. The private sector has saved meanwhile and reduced its debt as well. In a way, this region went against the emerging market trend of accumulating debt. It went the other way around. It reduced debt, it saved a lot, and it entered the COVID crisis in a much better situation. So there's a lot of pent-up demand. We think that this demand will grow in the next years or so. What households and companies need at the moment is the certainty there's not going to be another strong COVID wave and the region is not facing another lockdown, hopefully.
Okay, I mean, that's interesting. Now, obviously, one of the consequences of the pandemic is really an acceleration or increased focus on what EU can do, and what EU structures can be put in place to assist. And when we think about that, the EU funds that are being made available as a consequence of the pandemic, what role do you think those EU funds are going to play in the recovery? Is that going to help? And in particular, will it help companies with or should it help companies with their investment decision process in the CEE region?
Yes, this unprecedented amount of money that the EU has pledged to both Western Europe and Eastern Europe is one of the main advantages that CEE has over the next 6 to 7 years. And the reason is both direct investment, the money that the grants and the loans that these countries would benefit from, but also stronger demand from Western Europe, because all these countries are small open economies that export a lot. So if the money is spent as we expect in the EU, it's likely that there's going to be a double benefit for CEE. And talking about CEE proper and the money that it's going to receive from the EU, the amounts that we're talking about is coming from two main sources. One is the anti-pandemic packages. The first one was SURE, a package to help labor markets last year. The second one is Next Generation EU with this recovery and resilience facility that the EU is putting forward. And the regular one is the EU budget for 2021-2027. And if we're adding all up, we're talking about more than 430 billion euros that will go to these economies. So in terms of GDP, we're talking about something like 20% of the regional GDP over the next 7 years. And that's a huge amount of money.
That's enormous, yeah.
We don't know yet how countries will spend. They all submitted their frameworks to the EU. The EU is likely to answer before August, and the EU has said that by August, the latest September, they will start dispersing pre-funding to these countries. And it's very important because usually there's a lull of about 2 years between EU budgets when the region doesn't get much in terms of EU funds before it starts spending on the new projects. But this time around, Next Generation EU is going to breach this gap. So we're seeing investment growing very quickly in the next couple of years. If we're looking at the structure of investment, the EU has a blueprint on what countries should invest in. And they say that more than 37% of the grants out of Next Generation EU, the RRF, should go on a green transition. More than 20% of the grants should go on a digital transition, and the rest of the money will go into improving human resources, so retraining, into regional development, into infrastructure projects. We'll see exactly how countries want to allocate the money. If we're just looking at numbers, this slide summarizes the numbers. I put there Czechia's loans in red because they don't want to take them from the EU, and Hungary is thinking about taking the loans only in 2025. So some countries are actually struggling to come up with projects to cover all the money that the EU is ready to give them. In terms of the loans, what I want to say is that lending on 30 years would be priced at around 0.3%. So that's 1 to 2.5 percentage points less than what countries are currently paying for 30 years borrowing. So I think it's worth looking at those loans because it would definitely be the cheapest funding available to any emerging market out there.
And that's interesting. So would you say, so there's some parameters dictated by EU around that, but do you think you could see countries differing in terms of how they're applying it? I mean, obviously you've said they are, because some are actually still considering whether they wish to access them. But that could play a bit of an angle in terms of where you choose to make investment given an industry. If you've got, for example, one country that decides to really channel its investment into a particular niche, I mean, are they going to have that sort of amount of flexibility?
They will. All countries have different priorities. So there are countries that will like to invest more in road infrastructure and rail infrastructure. And here, Croatia, Bulgaria, Romania are probably the largest benefiters. Then there are countries that would like to improve their energy infrastructure, so transport of energy and gas. And that, I think, goes across the region. Then there are countries in need of a green transition, so move away from coal, probably first to gas, but then to green energy. And here Poland stands out because it is the country that's relying the most in the region on coal at the moment, and they will have to have this transition. And we're seeing many projects in green energy, especially wind. coming through at the moment and just waiting to see how much co-financing from the EU will be available, and it's going to be a lot of it. And that's across countries. Again, the largest beneficiaries from what we're seeing will be Bulgaria and Romania. Elsewhere, there are countries that want to improve their digital infrastructure, and there, for example, Hungary and Czechia want to spend more of their funding on this transition. Then there is the manufacturing component of Next Generation EU, because this green transition also means manufacturing of electric vehicles, it means manufacturing of batteries. And here Poland, Hungary, and Czechia are ahead of the pack, but all countries will benefit from co-funding for these industries. And then we're seeing large car companies from Western Europe starting to develop their electric platforms in the region and in a few countries. So that will also be beneficial. And finally, there's the part of the money that is neither green nor going to the digital transition. And there, I think there's a lot of scope for public-private partnerships in everything from infrastructure to urban development to housing projects. And again, this is also the EU budget for 2021-27 that's coming in. There are a few countries with, I would say, debatable success in this public-private partnerships, and I think legislation has to improve everywhere. There's been some such partnerships, for example, in Slovakia, that haven't gone very well in building roads and developing infrastructure generally. But countries will have to do that because they have to go to the EU with the projected funding for at least 60% of the funds by the end of 2022. So there's a pretty limited window of opportunity for them to do that. Something else I would like to add is that this bounty of money coming from the EU, it is easily available, but all investors will need some local knowledge. And from our experience with EU funds and foreign companies coming and investing in EU funded projects, there are several stages of this EU funding. And the first one would be some pre-funding that comes from Europe, and banks top that up. Then there's a bridge fund, a bridge loan given to companies developing EU funded projects, because the EU first receives the invoices and then disperses most of the money. So it has to be pre-funded somehow, and this is where banks come in.
Okay, so if I try and pull that together a little bit, it sounds to me as if there will be some local variances and place, perhaps into a bank like UniCredit's hands, where because we're physically present on the ground, we'll be, accessing and front running and with all that information, just in terms of practical application from a country by country basis. So no, that's helpful. But I guess in terms of EU funds, anyone that's interested in receiving those, it's not going to come in euro, right? It's going to come in local currency. So that throws up, certainly from a treasurer's perspective, a number of risks. So, on those two main themes within that, FX rates and interest rates. With that in mind, anything that you can add for the audience here that would be helpful, and mindful of that currency mismatch that inevitably is going to occur?
So I think everyone is looking now at reflation affecting all countries globally, and we do receive many questions about inflation going higher in CEE, and there are a few countries where inflation is well above target, especially Hungary and Poland at the moment, and what that could mean for local rates and also for the currencies. So if we're looking at inflation, there's clearly a cyclical component. The fact that these economies reopen and people have the money to spend means that service prices especially are increasing much faster than they did when these economies were closed. And we've seen this acceleration in the spring, and it's likely to continue over the summer. At the same time, there are several external shocks affecting these countries because fuels have been more expensive, food prices are rising globally. Generally, commodity prices are higher than they were at the beginning of the year. So that, again, adds to inflation. And there's a question whether central banks can remain credible if they don't do anything. And we've seen a change in the attitude of central banks. The Russian central bank has been increasing interest rates already. We're expecting them to increase rates again this week. And they're very likely to take the official rate to 6% by the end of the year. Later this month, it's likely that the Czech National Bank and the Hungarian National Bank will also increase interest rates, and they're likely also to deliver more rates afterwards. Poland is the country that's been reluctant so far to increase interest rates, although I would say inflation momentum in Poland is the strongest across these countries. And maybe I should mention that in Poland, there's also been a shift in the way the government plans to fund this recovery with more redistribution. They do plan to increase transfers to households, and they plan to tax both companies and those better off more than they did before. And that's probably a trend that we're going to see across the EU. What it means for companies in Poland is higher taxation at the same time with higher labor costs. So if I were to look at inflationary pressure at the moment, I would say it's likely that this inflationary pressure will persist into 2022, and central banks will have to fight it, because otherwise we're going to see currencies depreciate. And we've already had 2 episodes of depreciation, but when we're looking at intrinsic value, at the fundamental value of these currencies, we're not very concerned with any of them having to depreciate very quickly. Maybe with the exception of the Turkish lira, and that's a separate case because of the public policies in Turkey. But in Central Europe, the forint, the Czech crown, the Polish zloty are actually very close to fair value. So if there's going to be pressure on these currencies, it's likely to be temporary. The biggest changes that we're going to see over the next year or so is going to be in interest rates, and interest rates will rise quicker than they do in the Eurozone. Here, probably the countries that are already in the Eurozone, like Slovakia and Slovenia, and the countries that are expected to join the Eurozone in 2023 or 24, Croatia and Bulgaria are a better place because their interest rates are not going to rise. But even this rise in interest rates is unlikely to affect domestic demand because, as I said, we're seeing these huge savings accumulated over the last year, and households are likely to spend out of those.
Okay, thank you, Dan. Well, being conscious of time, I'll take the opportunity to once again, thank you for joining us on this slot and for your time and insight into the CE region. One thing I would say for the audience's perspective is the next CE Quarterly Report, and this is the flagship publication produced by Dan. That's going to be out at the end of June, so the end of this month. So these slides that you've been seeing during the course of the discussion, they'll be available on the UniCredit virtual stand, but we would encourage you, please do contact us directly. We'd be happy to share further insight and information, and indeed if you want to receive a copy of that CE Quarterly Report, which is a much more insightful and deeper dive into the region, then contact us directly. Indeed, you can use the virtual stand if you want to chat with the team that's attending the conference today, and more than happy to link you up with the right people. And Dan, really, he sits there. There's a team of people behind as well. It's very much broken up on a country by country basis. And this is stuff that he and his team literally do live, eat and sleep through, so very intimate with the intricacies of the CE region. Well, thanks for listening, and as I said, visit us on the virtual stand. Many thanks.
Thank you.